Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I'm joined by Iain Fulton from Amova Asset Management. Based in Edinburgh, Iain is a portfolio manager for the firm's global equity strategy. Though before entering the world of investing, he was an honours graduate in Scottish history. He's going to talk about the current state of global equities and the risks and opportunities that investors need to know about. Welcome, Iain. It's great to have you here today.
Hi, Anna. Thanks. It's great to be here. Yeah.
Thank you. So with that academic background in history, I imagine you bring a unique perspective to the events we've seen in markets over the last 12 months. How are you reading the global equity backdrop right now? And I can't resist asking, are there any historical parallels that stand out to you?
Yeah, thanks, Anna. It's certainly a fascinating time, as ever, in global equity markets, but none more so with the things that are going on from a policy and market point of view. In terms of that historical context, I mean, not even in the too far distant history, you just need to look at 2000 and you can see there are parallels in terms of market concentration and some of the speculation that sits around some of the asset classes around equities and more geared entities in particular. But I think there's a significant difference this time around relative to 2000. You know, tech was obviously the dominant sector at that time. It is again today. But this time, those tech companies are definitely backed up by really high levels of profitability, free cash flow, high returns on capital, and that kind of justifies their position as the preeminent class and leadership within the equity market that we've seen over the last few years. And that was a little bit different to 2000, where tech stocks were in the vanguard of the increase in markets, but they definitely didn't have the profits and cash flow to back that up. And that's part of the reason that probably ended in a more difficult circumstance than we've seen so far.
So you've suggested that Capex rather than consumption will drive the next leg of growth. Can you unpack that for us on what that means? Because it seems different geographies have, different consumption stories. At the moment, for example, in China, we're seeing the rise in consumption. If you could break that down a little bit.
Yeah, I guess that comes back to developed economies in general, that that it's maybe more of a Capex driver this time, and is partly due to the scale of the Capex wave that we're seeing from the hyperscaler tech businesses investing in AI infrastructure. $400 to $500 billion run rate of Capex is an extraordinary amount. And then the ancillary expenditure into other areas like power and grid infrastructure, all the things that you need to set up and operate a data center, the supply of power that you need to ensure that the grid continues to operate in that context. So there's a real incredible growth in Capex from that side. We've got a stimulus programme coming in Europe with €500 billion of expenditure on infrastructure, the same again on defence as the debt break's been released in Germany. So Capex seems like a primary driver within the kind of developed market areas, outside of Japan. But as you say, China with new stimulus measures, they've been going through a difficult period from a consumption point of view. You've got direct debt subsidies to assist consumers in big ticket purchases now. You've also got debt subsidies for the service sector, and that should help employment, and that should lead to a better consumption environment going forward. Maybe not the rates of growth that we've seen in the past there, but certainly better than we've seen more recently. So yeah, maybe that's a divergence that's interesting to note. There's definitely a lot of potential in some of these consumer areas across Asia.
The presentation that you did recently highlights the AI investment cycle. We've seen spending exorbitant amounts of money in the AI race with pretty insignificant returns in comparison. How are you wrestling with that, and how do you separate the genuine winners from the hype?
Yeah, I think I'd maybe dispute the small returns on capital expenditure. I think it varies company by company, and that's maybe one of the slight myths that's around in markets at the moment, that big cap tech is just one homogenous asset class. And if you look at the returns over the last couple of years, you can see there's a big spread in the performance of those companies. The businesses that have delivered improving return on capital, even with this very large expansion of Capex, those businesses that improved their return on capital, like Meta Platforms, Nvidia is the obvious beneficiary of that Capex. They've improved their return on capital dramatically. They've been the big outperformers, while Apple and Tesla over the last 2 years have struggled to deliver that improvement in return on capital, and they've performed less well. So I think, for us, the expenditure on AI in many cases, it really is supported by earnings and cash flow. And for those businesses that are continuing to deliver an improvement in the return on capital for their overall business as they commit that new spending, that's a good thing. And they might continue to perform if that equation, holds in place. If the return structure begins to deteriorate because we have excess capacity, then that will be much more problematic. But I don't think we're quite there just yet.
Your team's investment philosophy centres on future quality companies. Can you explain what that means in practice? How has it guided decisions like investing in new holdings like L'Oreal and MasterCard?
Yeah, sure. For us, future quality is all about, high quality businesses that can stand the test of time. So high profitability, good and improving returns on capital, that's what we look for. So businesses that are reinvesting to sustain their franchise, to sustain, the quality of the return structure within their business. And, companies like L'Oreal and MasterCard, they're so strong within their respective industries. L'Oreal, obviously, in beauty, you've got ongoing geographic growth for the beauty market. It tends to do better than the average staple company through the cycle. You've got penetration into new markets like the male market, for example, and other verticals that they can move into. So, we're long-term very optimistic about the ability for those businesses to compound up your capital over time. They might be a bit dull, not that exciting, but they've certainly got that compounding nature, and MasterCard's an excellent example of that as well.
Diverse and unique alpha sources remain a key focus, particularly when macro drivers are uncertain. You stress the importance of idiosyncratic growth drivers like market share gains. Can you share one or two stock-specific examples that outweigh the broader market backdrop?
Yeah, I think that's probably becoming increasingly important given the cross currents that we've got from a macroeconomic point of view. So businesses that can take market share and probably have that element of pricing power are going to be very important to have around. We like companies like Netflix, so their ability to achieve really good levels of audience engagement, 300 million subscribers worldwide. It's quite a unique property in the media industry from that sense. Their content continues to drive really high engagement. That gives them an element of pricing power. We're all well versed in that little increment that we get every now and again, but it's a small amount to pay for high quality content. But on top of that, more recently, they've added the advertising revenue opportunity into the business model, and we think that actually expands the addressable market for the company quite significantly. And importantly, it doesn't add materially to the cost structure of the business. So you've got good pricing power, steady growth from your core users, a new revenue stream in advertising, and all with improving margins and improving return on capital. So it's exactly the type of company we like to own in difficult economic environments.
Yeah, sure. So you describe defensive growth as a portfolio anchor. Why is that important, and what are you trying to achieve? And can you give me an example of that?
Yeah, well, I think we've spoken about L'Oreal. There's companies like Coca-Cola Europe Pacific Partners, which has got the old Amatil business in there and accessing the kind of better growth parts of the Coca-Cola system. And yeah, it's these businesses that are maybe not exciting, but they've got that good compound growth characteristic that will serve you well, over the very long term. And, I think those defensive areas of the market have been, in relative terms, under a lot of pressure because they don't have the growth rates that some of the more exciting areas like technology or some of the more cyclical companies that have been in an upcycle, give you that, short-term boost, and these are more the steady, long-term compounders, and they've been under pressure because we've had quite a favourable environment for cyclicality, but there's always a place to have those businesses in your portfolio, and when they've been under this amount of pressure, we think there's getting to be some interesting opportunities for those really high quality compounding stocks that can just serve a good place in your portfolio.
It seems like you've given a lot of airtime to healthcare and life sciences in your portfolio update presentation. What's compelling about it?
Yeah, it's been a difficult area, and they had a real cycle post-COVID where they pulled forward a lot of demand for, the research and development activity for vaccines and new drug development in the biotech sector. They were consuming a lot of equipment and the consumable products for the life science and tools industry, and companies like Danaher and Biotechne benefited greatly from that. But then in the aftermath, that really slowed down. There was an excess of inventory, and they've had quite a difficult cycle, which has taken a long time to work its way through without really a major change in the competitive positioning of the businesses. The demand has just dropped off. But there's some green shoots now, and you're seeing quite good commentary around forward orders beginning to pick up. So again, an area that's been under pressure that we think now has a pretty good outlook and is quite exciting relative to something that's been quite challenging over the last few years.
You also made some portfolio moves and changes to some interesting companies. Can you tell me what you did and why? I've got 3 well-known names. Let's start with Booking Holdings. That's booking.com.
Yeah, Booking Holdings is maybe back in that category of market share gainer, and everyone maybe was a little bit concerned about a slowdown in the consumer-facing part of the economy in the West, and how would travel hold up. We had the revenge travel post-COVID, and then was this another cycle? But I think, personally speaking, you don't remember that lovely, jacket you bought, when you're looking back on your life. You actually remember the experiences that you had with your friends and your family. So the desire to travel is something that's very innate, and Booking have been, really taking market share in alternative accommodation away from Airbnb. Part of the benefit being that you can compare the hotel price and the alternative accommodation in one place, which you can't do on some other sites, and that's been helping them to take market share. You probably notice when you use the site, you've got experiences, you've got attractions, you can book a transfer, you can book airline tickets now, car rental. So they're capturing more of the share of the travel wallet. And that's been, actually, with a very high level of profitability, 60% return on capital. And that's been a lovely, compound story for our portfolio over the last few years.
Yeah, I'm a fan of Booking.com. Okay. Just used it to book a holiday.
There we go. I think we all do.
Revenge travel, that's a good one. I haven't heard that one before. Let's talk about Sony next.
Yeah, I think there's an interesting thing going on in Japan more broadly around that focus on improving. They would use the term return on equity, we would use return on capital, but it's focusing on your areas of expertise. And Sony are now spinning off their financial services arm. They had Sony Life, which isn't really core to a technology company who are one of the leader in video gaming, a leader in music publishing, a leader in the semiconductors and the CMOS sensors that go into your camera unit on your iPhone. So focusing on the areas where you have that real expertise, we think is the best way to maximise the growth and profitability for your business. So spinning off the financial arm, we think unlocks a lot of potential within Sony, and we think that's a very exciting opportunity.
Okay, and thirdly, let's talk about Uber.
Yeah, a lot of controversy around Uber, and will it be cannibalised by self-driving cars? And that's definitely an issue for the long run. But short to medium term, Uber really have been benefiting from the investments that they've made in their network over the last decade. And you're now at that inflection point where the growth in costs is actually much lower than the growth in your revenue, and you're seeing expanding profit margins and expanding return on capital, and that's led to a really good share price performance, and the valuation is actually still quite compelling. So again, that's one that we like for the medium term, but still with a weather eye to the competitive threats from autonomous vehicles in the longer run.
Finally, and I'm not going to ask you to predict the future, but as it stands, what are the biggest risks for global equities in the next 12 months? And equally, what do you see as the biggest opportunity?
Yeah, I think the biggest risks are probably back to that, the sustainability of the cash flow growth and profitability on those big tech companies that's underpinning the growth in capital expenditures on AI. If that slows down, that's been a significant engine of profit growth for the US, and that could be, a definite challenge if that equation were to change. We're not seeing signs of that just yet, but it's certainly something to keep a very, very close eye on. Opportunities, maybe not the biggest opportunity, but something that's a little bit interesting maybe is that kind of adoption of Asian culture and use the term Japanification if that's a word, but the growth in anime and the growth in Japanese style culture in the West is something that's been quite extraordinary over the last few years. Crunchyroll, which is owned by Sony, has seen extraordinary growth in the kind of distribution of anime. They're the kind of Netflix of anime, and it's interesting that we think there's a big opportunity for intellectual property companies to export into the West. And it might be something to do with young people, I think, in the West and it's a generalisation, obviously, but there's an element of struggling to get on the property ladder, maybe stuck at home, working in a job that they're overqualified for. So the easy thing to do and a healthy thing to do is to escape, and video gaming or anime or that kind of fantasy culture is proving to be extremely popular. So we think there's a big opportunity. If you look at the characters like Pokemon or the scale of those franchises, they're billions of dollars now, and the opportunity to grow and sell that intellectual property into Western markets, we think is really compelling.
Thank you, Iain, for joining Livewire today, and enjoy the rest of your time in Australia.
Thanks, Anna. It's a pleasure.
If you enjoyed that interview, give it a like, and don't forget to subscribe to our YouTube channel. We release new content every week.